Hello and welcome to another episode of Full Court Finance here at Zacks. I'm your host, Ben Rains, and today we're taking a look at Amazon and Meta to consider if we should buy these mega cap tech stocks for long-term growth in the broader tech space and the AI space. So before we get into everything today, I wanted to say remember to subscribe and leave a review wherever you listen to your podcast, and make sure to check out our Zacks.com/promo page for a look at some of our services, portfolios, and more. So before we jump into Amazon and Meta ahead of their earnings releases next week, and just as a note, I'm recording this Thursday morning. I just want to go over where the market stands just to give a better sense of possibly these two stocks and what might happen in the next few weeks. So the S&P 500 and the NASDAQ barely moved to start the week, and it looked like maybe Wall Street was going to sit on its hands until the big tech powers start reporting next week. Then obviously Wall Street can be pretty unpredictable. So the NASDAQ then fell 1.6% on Wednesday, and the S&P 500 closed about 1% lower. The drop prevented the NASDAQ from returning to its summer peaks. So it's possible now Wall Street may ramp up some of its profit taking. As I record this, the NASDAQ is up about 0.4%, so a little bit of a boost here this morning as I record this. But Wall Street is going to have to possibly hold that 21-day moving average to close out the week, or maybe we could see some more selling heading into next week, which is going to see the release of Alphabet and Microsoft and Apple and Amazon and tons of other mega cap technology stocks. And then obviously after the final week of October, we have the presidential election after that. So this is kind of a big 2-week stretch where you could see some profit taking, just considering the massive run we've been on in 2024 and off the 2023 lows, that there's a good chance just with the uncertainty kind of sell the news, especially if the companies have even solid reports next week, that you could see some profit taking. That said, though, Taiwan Semi's impressive results last week could signal that there's plenty of major longer term upside after this stretch of possible volatility. So it doesn't mean run for the hills, but just maybe load up on some cash and get ready for the next little bit of a pullback. And then we saw Tesla report on Wednesday night, and the stock soared 10% after hours and was up big this morning as I record this. So that's a positive sign for the big tech companies that are going to report next week. And it's also worth noting that some of the recent selling comes as the 10-year U.S. Treasury yields jump back up to some summer levels, as Wall Street's kind of backing off its bets that the Fed's just going to go gung-ho and really chop its interest rates. That said, it's worth noting that a slower easing cycle is preferable to rapid rate cuts, because rapid rate cuts likely means the U.S. economy is tanking, which is obviously not a good thing if you're an investor. And overall, along with lower interest rates, a slower interest rate cycle, a slower easing cycle, I should say, the overall earnings outlook is pretty strong. So for Q3, we're calling for 3% earnings growth. We're calling for 9+% growth in Q4, 12% growth in the first quarter of 2025, and 13.5% growth in the second quarter of 2025. And through the first several weeks of earnings season so far, Q4 estimates have held up rather well, which is solid. So as I said, we're calling for 9.3% growth in the fourth quarter in terms of S&P 500 earnings, which is a really strong sign. So that's a bullish backdrop, and a little bit of selling could go a long way. So if we get below that 21-day, maybe look for the 50-day to start getting in after maybe the election if you're more of a trader. If not, these stocks we're going to talk about today seem like longer term buys at the moment here. So the first of these two stocks we're looking at into is Meta Platforms. Meta used to be Facebook, now it's Meta. Trades in the ticker Meta, META, and the company is set to report its Q3 2024 earnings results on Wednesday, October 30th. So Meta shares have surged about 60% year to date and 340% in the last 2 years. Meta has crushed the tech sector over the last decade and the past 5 years, yet it's trading at a really big discount to the tech sector in terms of forward earnings and miles below its own highs, which shows that its earnings outlook continues to improve. So let's kind of dive into all things Meta and why you might want to consider buying Meta heading into that release or possibly after. So rising rates and Wall Street's huge pushback on its initial metaverse bet forced Mark Zuckerberg to quickly kind of refocus on Facebook / Instagram / WhatsApp's core competencies, cut costs, and then just focus on the bottom line. Efficiency is now kind of the name of the game at Meta while also expanding. So the digital ad market, though, as well declined in 2022, which then all of those events saw the company post a 1% year-over-year drop in sales. But that period looks to be kind of just a blip on the radar at this point. So Meta's various apps serve different pockets of social media and digital communication, and it stands to benefit from the never-ending need for advertisers to reach people who are simply just addicted to their smartphones. So Facebook, they own Facebook, Instagram, WhatsApp. Those daily active users were up 7% in the second quarter of 2024 to 3.27. So essentially 3.3 billion users. Ad impressions were up 10% year over year, and the average price per ad was also up 10% year over year. So just really impressive growth. So on top of reaching over roughly 3.3 billion people, Meta is investing heavily in its AI future, and over the summer, or it's getting into its own AI chips to compete alongside NVIDIA and others. And it's also really focused on kind of a different way to play the AI game. So over the summer, Zuckerberg wrote a big note about how Meta is getting into open source AI. And they cited how Linux gained popularity versus its rivals to become the industry standard foundation for both cloud computing and the operating systems that run most mobile devices today. And he wrote at the time this summer that said, quote, "We are taking the steps towards open source AI becoming the industry standard and releasing the latest version of its Llama, its open source model, AI model. In addition to having significantly better cost / performance relative to closed models, the fact that its 405B model is open will make it the best choice for the fine tuning and distilling smaller models." So they're betting that their open source way to do AI is going to be a long-term huge winner. And it seems like Wall Street's pretty convinced of that too at the moment, if you dive into some more of the stuff we're getting into. So that's really good to know. And then the firm's also committing obviously billions to its AI bets alongside everyone else. And they're pivoting, as I said, towards this more open source model, which could pay really big dividends down the road. And obviously its digital advertising is dwarfing its smaller competitors kind of everywhere in the digital ad space. So that's going to allow it to continue to invest in this open source AI while growing its core business. The company also said last quarter that it had a strong quarter, and that Meta AI is on track to be the most used AI assistant in the world by the end of the year. So they're really, really bullish on all things AI over at Meta. And with that said, Meta's revenue is projected to jump 20% in 2024 and then 14% next year, to go from 135 billion in 2023 to 185 billion next year. So as I said, 20% growth this year and then 14% growth next year, which would come on top of 16% revenue growth in 2023. And then on the bottom line, we're calling for 44% adjusted earnings growth and then 14% adjusted earnings growth on top of that in 2025. And this would come after a whopping 73% bottom line expansion last year. And its earnings revisions have just improved significantly over the last year. So its Zacks consensus estimate for 2024 is up 22% over the past 12 months, with its 2025 outlook up roughly the same amount, 22%. It's also crushed our estimates in the trailing 4 quarters by an average of 13%, and some recent positivity. So its most accurate estimates for Q3, Q4, 2024, and 2025 are all coming in slightly above consensus, and this helps it earn a Zacks rank number 2 buy at the moment. And then behind all of these big bets and this big growth business that it's operating at the core of its company, it has a really strong balance sheet that's going to help it pursue obviously its AI growth efforts and then kind of any future growth areas down the road. So it has $58 billion in cash and equivalents. Its free cash flow was roughly $11 billion last quarter. It has $230 billion in total assets versus just $73 billion in total liabilities. It also earlier this year confirmed its commitment to shareholders and just kind of flexing its muscles that it's still being able to do double-digit top and bottom line growth, but also it's going to start. It's now paying a dividend. Wall Street's really high in the stock. 41 of the 48 brokerage recommendations that Zacks has are strong buys. And now if we get back to its performance, as I noted up top, it's up 60% year to date and 340% in the last 2 years. And this is also part of a 600% run in the last decade, which nearly doubles tech, not quite. The tech sector's up about 333%. That said, it's down around 5% from its peaks. It could face some selling pressure to get back to its 21-week moving average and possibly ready to test its 50-day in the near term. That said, it's already cooled off significantly in the last several weeks, so that's a good sign heading into earnings. And also, despite its rebound in its impressive long-term performance, it's trading at a 10% discount to the Zacks tech sector, and 70% it's below its own all-time highs, even though it's trading right near its all-time highs in terms of price. It's trading at 24.5 times forward 12-month earnings. And for reference, the current king of the AI world, NVIDIA, trades at 43 times. So if you're high on its ability to grow that open source AI business while also running a really impressive digital ad business that's not going out of style anytime soon, considering how popular its various apps are, that it's a good price point, and sort of looking at Meta as a value play here at the moment, trading at just 24.5 times forward 12-month earnings. And now we're going to move on to Amazon, which trades in ticker AMZN, with the company set to report its Q3 2024 results on Thursday, October 31st. So Amazon shares are up around 20% year to date, which lags the tech sector's 27% run. And unlike Meta and others, the stock's only up about 120% from its lows. So a lot of these companies that got hit during that 2022 downturn have roared back and stormed to new highs. Amazon is not one of those. In fact, it hasn't been able to break meaningfully above its 2021 peaks, with it trading right around those levels at the moment. So let's kind of dive into why now might be a time to consider buying Amazon stocks. So slowing cloud growth and higher interest rates hit Amazon in a big way in 2022, alongside most of the tech sector. Obviously, the higher rate environment then forced Amazon to focus on profits and maximize efficiency under CEO Andy Jassy, who obviously took over from Jeff Bezos. And Amazon still runs the world's largest cloud computing business, and cloud computing is a key pillar to the modern economy. And the combination of steady cloud computing growth and a concentrated effort on boosting earnings now and down the road has kind of breathed fresh life into Amazon, though people are still a little nervous. And we'll get to some of those reasons why, but maybe this is a good time to buy still. So Amazon reportedly held 31% of the cloud computing market last quarter versus Microsoft at 25% and Google at 11%. Amazon's also attempting to improve its cloud computing, so AWS margins, by rolling out more in-house chips. It's also actively rolling out more AI-focused efforts to attract customers to spend more, as the race is not to get left behind on the new frontier of tech. Its CEO has talked about the AI revolution while also committing to cutting costs. It's planning on spending over $100 billion over the next decade on data centers to roll out its AI efforts. It's devoting more money now to those AI expansion efforts than to its e-commerce network, which is a positive sign since that will be a higher margin business. And then on the e-commerce front, though, Amazon is benefiting from the transition from a single national fulfillment network to a single national fulfillment network, which is a positive sign, as that is a small margin business. That said, it still currently holds 40% of the total e-commerce market share in the U.S., blowing away Walmart at 7%. It's also growing its digital ad segment. That segment climbed 20% in the second quarter, making it the largest year-over-year gain on a percentage basis, outpacing AWS, which was at 19% growth. So it's got a lot of different growth areas it's focused on as that e-commerce business slows a little bit. And then obviously, as I mentioned, investors are a little worried about its earnings and margins growth. It averaged an annual operating margin of 2.6% between the years of 2010 and 2019, but its cloud and ad segments have helped improve that in a big way. With an operating margin of 9% for the 12-month period ended last quarter. AWS itself hit 33.4% last quarter. So those are the businesses that need to continue to improve. Amazon's operating income is expected to surge 69% this year and then average 24% annual growth over the next 3 years, which would vastly outpace the 11% revenue growth the company is expected to average over the same time. But some side bets might be holding it back. So it's not a big business for Amazon, but they are trying to send low orbit satellite networks designed to provide broadband internet connections to underserved parts of the globe. They're competing and lagging very far behind at the moment against Elon Musk's Starlink. So we'll see if that's something that maybe they pull the plug on. It's a longer term bet that Jeff Bezos made before he left, and those are things that Wall Street's looking at is they need to focus on at maximum efficiency. And if this is a business that's kind of dragging the company down, maybe they should look into getting rid of it. So at the moment, most recently in the second quarter, they topped our bottom line estimates by 17% after a 36% beat the quarter before that. And they've averaged a 31% beat in the trailing 4 quarters. So we're calling for roughly 10.5% revenue growth this year and then 11% growth next year to go from, and the numbers are just kind of staggering, $575 billion to $703 billion between 2023 and 2025. And then on the bottom line, we're calling for 64% adjusted earnings growth this year and then another 23% adjusted earnings growth next year. And this would come after the company swung from an adjusted loss of 20 cents per share or 27 cents per share in 2022 to positive $2.90 per share in 2023. So this could be 3 straight years of strong bottom line growth, which is what Wall Street's hopefully looking forward to Amazon continuing. Over the last year, its 2024 earnings per share estimate is up 41% with its 2025 estimate up 30%. So the bottom line revisions are climbing. That said, it lands as Zacks ranked number 3 hold because of some recent stagnation. Its revisions have kind of remained unchanged over the last several months for 2024 and 2025. But as I mentioned, it's beat handily over the last 4 quarters. It's also trading roughly 20% below its average Zacks price target, and 45 of the 49 brokerage recommendations that Zacks has are strong buys with no sells. Its shares are up around 110% in the last 5 years, which lags way behind the tech sector, which is up 150%. And it's, as I mentioned up top, it's failed to break out meaningfully above its 2021 peaks. It's now trading 8% below those July highs, which were its all-time highs, and around its previous 2021 peaks as we speak. It could find some support at its 50-day or its 200-day moving averages, and which is kind of hovering around those 2021 peaks at the moment. It's trading at below neutral RSI levels. It's also trading right near its 21-week moving average. So if you're looking at some technical levels, maybe you want to get in if it finds support at any of those levels. That said, if we look over the long haul, Amazon stock is up 1,200% in the last 10 years, blowing away tech, which is up 330%. It blows away Apple, which is up around 780%. Alphabet up 500%. Meta up 600%. So Amazon has blown all these stocks away over the last decade, and its recent stagnation could then maybe be a good chance to buy into Amazon. Its valuation front, it's trading 95% discount to its highs and over a 50% discount to its 10-year median at 33.6 times forward 12-month earnings, and not too far above its all-time lows. And then if we look at its PEG ratio, which factors in its longer-term earnings growth outlook, it's trading at a 25% discount to tech at 1.2. So with that all said, it might be time to consider buying Amazon stock heading into that third quarter earnings release on Halloween next week. So that does it for this episode of Full Court Finance. Until next time, I'm your host, Ben Rains. And remember, if you have any questions, please feel free to shoot us an email over at podcast@zacks.com.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.